what was the other question? The other question has to do, I don't know, Flora, about the profit margin.
Mhm.
So we're trying to maintain a price structure, and we include 3 different factors in it. The first one is the cost of the furniture to eventually save funds and replace in 3 years, 1 year time, whatever it is, having the funds to replace or to replenish our stock. So the way we calculate that, it's 20% on the retail price of the furniture being used in that specific project. So we make a list, we add up the numbers, we obtain the 20% on the retail price of all the furniture included in the staging, and that's the first factor. The second one is all the variable costs, labor, transportation, the truck, the miles, the gas of the truck. So whatever is variable, we put it in the second place. But then the most difficult part, it's to calculate the third factor, which is the profit margin. We don't really know where it is. We are estimating 30%, but we wanted to have your input in case you do have some sort of range for us to cover all the overhead costs or the fixed cost, including warehouse, insurance, liabilities, all of that.
Yeah. So you are probably in a very different market from us here, and you can get that much for your staging. You can charge that much. Here, we can charge about 15% of our wholesale cost, and that's it. We can charge for, we do charge a delivery, and that starts around $1,200-$1,300 for that includes pickup as well. So, but other than that, that 15% is all we're able to charge. Now, again, you may be able to charge a lot more in your area, but if you can, that's gravy. So what we calculate on is that the first 6 to 7 months of rental just solely goes back to recouping our investment in the furniture. After 6 or 7 months, then it starts making money to pay for the labor and the warehouse and the trucks and the gas and all of those things, you know. So it takes 18 months or something before we start seeing a profit on that furniture. But then that profit goes, see, I mean, you're going to go underwater because you got to pay, you got to buy the stuff ahead of time, right? And so you're underwater for a while, and then you start coming back up and you get that paid off, and then your profits just go straight up because, and once you got that paid off, it's practically all profit. I mean, yes, you've got your fixed costs, you know, your utilities and your rent and all of those things, and your payroll, but your profits are much higher. So in that 2 to 3 year range, depending on how fast you're growing, that's when you really start seeing your profits, because you've got the first houses, your first level of inventory paid off, and now you're starting to make enough to be buying the next house's worth of inventory. But it takes a couple of years to get there to where you're really seeing the profits. Now, again, if you're in a market where you can charge more than that, that's awesome. You're going to get to that good profit margin way ahead.
Well, I mean, we passed already the first 2 years. This is for us currently the third fiscal year.
Mm-hmm.
And so the better question would be, what was your profit margin percentage when you were doing home staging?
We are still doing home staging.
Okay.
Yeah.
What is your, I mean, can you give us a reference?
Yeah. We're still a very active home staging business. We have 50, 60 houses out at any given time. So yeah, we're, so we operate about a 20% profit margin. Yeah. So I think that's, and we're in communication with a lot of big stagers and they as well, that, I think that's pretty typical to, if you, that's pretty healthy. If you can operate at 20% is pretty healthy. Now, when you're in your big growth years, that's when you have the hardest time being profitable. It's kind of counterintuitive, but it's actually when your business levels off in those plateau times. That's when you really get to see the most profit, because when you're growing, you're also buying like crazy. And so once you reach kind of the level where you want to be, then you want to try to level it off and not keep spiking it up, because you can't get those profits then. So kind of level it off. And, you know, if you have a bell curve of like maybe the winter months, you're here, and in the summer months, it goes up, and you have a bell curve here, and you have, this is your maximum um, potential of what you can handle, the business that you can handle. Okay. But down here, you're missing out on a bunch of profits because you're ramped up. You've got your systems and your inventory and your personnel and everything to meet this demand. But so much, all of this in between here is loss, really. And so what you want to do is define a level here of you kind of your mid-range of, and not try to meet as much demand as there is. But meet in here, so you're not losing stuff out on those ends. Does that make sense? I don't know if I'm explaining that very clearly. So, and then you use pricing as your throttle on how much business you take on. So to stay at this level, you know, when it's slower season, you're going to lower your prices so that you're meeting that much business. And in the high season, when you've got way more demand, you're going to raise your prices to where you're still only doing this number of houses. And that will keep your income and your number of houses and your amount of work a lot steadier, and keep your profits a lot steadier.